Hello, today is June 30th, 2025, and we're diving into public sector accounting. It may not sound thrilling, but it's crucial. This is about how governments account for your money. The rules are set by the International Public Sector Accounting Standards, or IPSAS. We're focusing on Ipsas 23, revenue from non-exchange transactions. This standard covers income governments receive without giving something of equal value in return, like taxes and grants. When you pay taxes, you don't get a product back, you get public services. Ipsas 23 ensures this revenue is reported consistently and transparently worldwide. It's about accountability, making sure public money is tracked clearly. Most government income comes from these non-exchange sources. Without clear rules, public finances would be chaos. Today, we'll break down IPSAS 23, explain non-exchange transactions, and show you the real accounting entries behind public money. Let's get started. What's a non-exchange transaction? It's when a government receives value without giving equal value back. Taxes are the classic example. You pay, but you don't get a direct product in return. Instead, you fund things like roads, schools, and public safety. Grants work the same way. A city might get money to build a library, but the grantor doesn't get a library in return. Donations are similar. A museum receives a painting, but the donor doesn't get an asset back. Fines and penalties? You pay, but you only get your legal obligation resolved. In all these cases, value flows one way, supporting the public good. These are the core non-exchange revenues governed by IPSAS 23. They're essential for funding public services. Understanding them is key to understanding how governments operate. Let's see how and when this money is officially counted. Governments can't just record revenue when promised. It's all about timing. IPSAS 23 says revenue is recognized when the government gains control of a resource and its value can be measured reliably. For taxes, this is usually when the taxable event occurs, like earning income or owning property. For grants, it's when there's a binding agreement and the money is probable to arrive. Non-cash donations must be valued reliably before being recorded. If a grant has conditions, like building a clinic before keeping the money, the revenue isn't recognized until the condition is met. Until then, the money is a liability, not income. Only when the government fully controls the resource and all conditions are satisfied does it count as revenue. This prevents overstatement and keeps financial statements accurate. The rules ensure governments don't count their chickens before they hatch. Next, let's see how these rules play out in real accounting entries. Practical examples make it clear. Let's see how governments record non-exchange revenue. For income tax when assessed, debit taxes receivable, credit tax revenue. When paid, debit cash, credit taxes receivable. For an unconditional grant, when received, debit cash, credit grant revenue. For a conditional grant, when cash is received, debit cash, credit deferred revenue, a liability. Once the condition is met, debit deferred revenue, credit grant revenue. For a non-cash donation, like a donated building, debit buildings, credit donation revenue at fair value. These entries show how assets and revenue are recognized only when the government truly controls the resource. Conditional grants stay as liabilities until obligations are met. This approach keeps public accounts honest and transparent. Every entry tells the story of how public money flows in. Understanding these basics is vital for public accountability. Now, let's clarify a common confusion: conditions versus restrictions. A key challenge in Ipsas 23 is telling conditions from restrictions. A condition means the government must meet a specific requirement or return the money. Until the condition is met, the money is a liability, not revenue. For example, a grant to build roads is recognized as revenue only as each kilometer is completed. A restriction, however, just guides how the money should be used. No return required if not followed. For restricted funds, revenue is recognized immediately, but the government must track how it's spent. The difference is crucial. Conditions delay revenue recognition, restrictions do not. Properly distinguishing them changes the financial statements and ensures accurate reporting. Governments must disclose and track restrictions, but only conditions affect when revenue appears. This clarity is essential for transparency and public trust. Next, let's wrap up with why all this matters. The big picture is about trust and accountability. Today we've explored Ipsas 23, the backbone of transparent public accounting. Non-exchange transactions like taxes, grants, and donations are the lifeblood of public services. Recognizing revenue only when control and value are certain keeps financial statements honest. Conditions delay revenue, restrictions don't. This distinction shapes how governments report and manage public money. Accurate accounting builds trust and supports better decisions. By mastering these rules, public sector accountants ensure financial reports reflect reality. This transparency empowers citizens and strengthens democracy. It's more than numbers, it's about telling the true story of public money. Understanding Ipsas 23 helps everyone see how their contributions support society, and that's a goal worth pursuing.